Welcome. Today we're looking closely at the first quarter 2025 financial results from Taiwan Semiconductor Manufacturing Company, TSMC.
Indeed. A lot to unpack from this latest report.
Absolutely. And before we really jump in, if you find this kind of analysis valuable, please do consider liking and subscribing. Helps us bring you more content like this.
Definitely.
Okay, so the big headline first. TSMC reported a pretty substantial year-over-year increase in revenue for Q1 2025.
Yeah, quite significant. We're talking a 42% rise compared to the same time last year in new Taiwan dollar terms.
42%. Wow. That really stands out for the first 3 months of the year.
It does. And alongside that, the earnings per share also came in better than expected.
Beat the estimates, right? And they also gave their outlook for Q2 and sort of reaffirmed the full year picture.
Exactly. They maintained their forecast for 2025 revenue growth overall.
So what was really pushing that Q1 revenue up so much?
Well, two key areas, mainly. Really strong demand for AI servers, which isn't too surprising given the trends.
Right. AI continues to be huge.
And also smartphones. Plus, there was another factor mentioned.
Oh, what was that?
It seems electronics manufacturers were building up inventory, stockpiling in U.S. warehouses.
Stockpiling? Why?
Apparently, in anticipation of potential tariffs, there was talk of them kicking in around early April.
Ah, okay. That makes sense. Hedging their bets, maybe?
Seems like it. And looking deeper into Q1, March was particularly strong, wasn't it?
Yeah, the report highlighted March 2025, showing a, was it 46.5% year-over-year revenue jump?
Right. And that timing lines up with reports about high U.S. demand for Apple's iPhones, possibly also linked to those potential tariff-related price hikes people were expecting.
So a bit of a pre-tariff rush potentially fueling some of that demand.
It could be a contributing factor, though TSMC's CEO, C.C. Wei, did address the whole tariff uncertainty.
What did he say?
Well, he acknowledged the risks, the uncertainties there, but he also stated quite clearly that as of the earnings call, they hadn't actually seen any changes in customer behavior because of it.
Interesting. So no panic buying or order cancellations noted, officially at least.
Apparently not, and that's probably why they're sticking to their guns on the full year forecast.
Which is?
They still expect full year 2025 revenue to grow by close to the mid-20s% range, measured in U.S. dollars.
Mid-20s% growth for the whole year. That's still very strong.
It is. And they also made a point of reaffirming their big investment plans in the U.S. chip manufacturing facilities there.
Right, the U.S. expansion.
Yeah.
Let's get into the specific numbers for Q1 then. Revenue was $25.5 billion US dollars.
Correct. 25.5 billion USD. But it's worth noting that was actually down about 5.1% from the previous quarter, Q4.
Okay, so down sequentially in US dollars. But the big year-over-year jump was in the local currency.
Exactly. In new Taiwan dollars, that Q1 revenue was NT $839.25 billion. And that's where you see that big 42% year-over-year increase we mentioned earlier.
Got it. How about margins? Gross margin was 58.8%.
58.8%, which, like the USD revenue, was actually down slightly compared to the quarter before.
Okay. And operating margin followed a similar pattern.
Yes, 48.5%. Also a small sequential dip.
And the earnings per share figure?
That came in at NT $13.94, which translates to about 43 US cents.
And that was the figure that beat analyst expectations, right? They were expecting slightly lower.
Yeah, I think the consensus was around NT $13.61, so a decent beat there.
Okay, let's break down that revenue a bit. Which technologies were bringing in the money?
Well, the cutting-edge stuff is really driving things. The 3-nanometer process, that accounted for 22% of wafer revenue in Q1.
22% from 3-nanometer alone.
Wow. And 5-nanometer, the slightly older node, was even bigger. That was 36% of wafer revenue.
So between just those two, that's almost 60% of their revenue.
Pretty much. And then 7-nanometer added another 15%.
So if you combine all of those, what they call advanced technologies, 7-nanometer, and below, what does that add up to?
That comes out to 73% of total wafer revenue in the first quarter. A huge majority.
Clearly shows where the value is concentrated. Now, what about by application? Where are these chips going?
High-performance computing, or HPC, was the largest segment by far. It actually grew 7% quarter over quarter.
And what share of revenue did HPC represent?
59% in Q1, so nearly 60% just from HPC. Think AI servers, powerful computing.
Okay. What about smartphones? You mentioned strong demand earlier, but how did this segment do overall in Q1?
Well, compared to the previous quarter, smartphone revenue actually decreased by 22%.
Oh, quite a drop sequentially.
Yeah, likely some seasonality there after the holiday quarter. It accounted for 28% of total revenue in Q1.
So HPC way up, smartphones down down sequentially, but still significant.
Yeah.
What about the other areas?
Let's see. IoT, Internet of Things, that was down 9%, making up 5% of revenue.
Okay.
Automotive, on the other hand, showed growth, up 14%, and also accounted for 5% of revenue.
Interesting. Automotive growing.
And finally, digital consumer electronics, DCE, that was up 8%, but it's a very small piece, only 1% of Q1 revenue.
Got it. So a mixed picture across the applications, but HPC is clearly the dominant force right now.
Absolutely.
All right, looking ahead now, what's the guidance for the second quarter?
They're expecting another sequential increase in revenue, around 13% growth compared to Q1.
13%. And what's driving that anticipated Q2 growth?
Again, it's the demand for the leading edge nodes. Strong demand for both 3 nanometer and 5 nanometer technologies is the key driver they cited.
Makes sense. And related to that, especially the AI demand, they talked about CoWoS packaging, didn't they?
Yes, CoWoS chip on wafer on substrate, crucial for high-performance chips like GPUs for AI. They announced plans to actually double their CoWoS capacity during 2025.
Double it. That's a significant expansion to meet that robust AI demand.
Definitely needed. That capacity has been very tight.
Now let's talk about the U.S. expansion again. They gave an update on the Arizona fab.
They did. Good news there, apparently. They reported that the Arizona factory has now achieved production yields that are comparable to their fabs in Taiwan.
That's a major milestone, reaching Taiwan-level yields.
It really is. It addresses some of the earlier concerns about getting the U.S. operations up to speed.
And they also upped their investment commitment in the U.S.
Significantly. They announced they now plan to increase their total investment in the U.S. to $165 billion.
Whoa, $165 billion? What was the previous figure?
I believe it was around $100 billion announced previously, so a substantial increase.
That's a huge commitment to U.S. manufacturing. Now, related to the U.S., there were some rumors swirling about Intel, weren't there?
Yes, the joint venture speculation. Reports suggesting TSMC might partner with Intel, possibly manage Intel's U.S. fabs, maybe bring in other designers like Qualcomm or NVIDIA.
Right. What did TSMC say about that?
They shut it down pretty firmly, explicitly stated during the call, no intention of forming a joint venture with Intel and no plans for any kind of technology transfer agreement either.
So a clear denial. That possibility is not on the table, as they put it.
Essentially, yes. They were very clear about that.
Okay, let's get back to the near-term financial guidance then. Specific numbers for Q2.
Sure. For Q2 2025 revenue, they're projecting a range between $28.4 billion and $29.2 billion US dollars.
Okay, so building on that Q1 base. And margins for Q2.
Gross margin is expected between 57% and 59%.
Slightly tighter range than Q1's actual. And operating margin.
Forecasted between 47% and 49%. So again, slightly lower perhaps than the Q1 actual, reflecting maybe some ongoing costs.
And they gave a tax rate expectation too.
Yes, around 20% for the second quarter.
All right. Reflecting back on Q1 performance, they did slightly beat their own guidance midpoint, didn't they? Even with some headwind.
That's right. They managed that despite, the usual smartphone seasonality slowdown and also the impact from that earthquake they experienced.
Right, the earthquake.
Yeah.
How much did that and the overseas costs impact margins in Q1?
Well, they said the gross margin was slightly hit by the earthquake costs and also what they call overseas dilution, basically, the initial higher costs of ramping up those new fabs outside Taiwan.
And they expect that overseas dilution to continue affecting margins.
Yes. They anticipate further margin dilution as those overseas fabs continue to ramp up. The operating margin in Q1 also saw a slight decrease due to operational factors they mentioned.
Did they quantify the expected margin impact for the full year from these overseas fabs?
They did. For the full year 2025, they're expecting a margin dilution of around 2% to 3% because of the costs of setting up and running those overseas facilities.
2 to 3% for this year and longer term.
They suggested it could potentially increase to maybe 3% to 4% in the following years as more capacity comes online internationally.
Okay, so that's a definite cost factor to watch. Let's circle back to CoWoS packaging demands. You said capacity was tight.
Extremely tight. They acknowledged that previously demand was much, much higher than the supply they could offer.
Has that situation changed?
They said it's improved slightly recently, but they're still working hard to double that capacity this year, as we mentioned.
And is that capacity fully booked?
Oh, yeah. Remains fully utilized. And they expect that very strong demand for CoWoS to continue right into 2026 as well. AI isn't slowing down.
No kidding. Now, focusing on the Arizona expansion again, what's the main driver there? Is it just diversification?
Customer demand is the primary driver they emphasize, especially demand from their major U.S.-based customers. customers.
So key clients want supply closer to home.
Seems to be a big part of it. They also mentioned they're working closely with the U.S. government to try and speed up getting all the necessary permits for the expansion.
Permitting can definitely be a hurdle. How does TSMC view this geographic diversification strategically?
They frame it as part of their value proposition, offering geographic manufacturing flexibility. And they also mentioned they're having discussions with key customers about, pricing strategies related to this.
Interesting. Suggests maybe costs are different or value is perceived differently for U.S.-made chips.
Potentially, yes, something they are actively discussing.
Despite all these moving parts, potential tariffs, geopolitical stuff, like the U.S. restrictions on AI chip exports to China, you said TSMC isn't seeing customer behavior change.
That's what they stated. No significant changes observed so far. And that's why they're holding firm on their full-year growth outlook.
They seem confident they can navigate those external factors for now.
For now, yes. They're maintaining the course.
What about the pace of the Arizona build-out itself? Are they trying to speed things up?
They are. Efforts are underway to accelerate the start of production in the second Arizona fab.
The second one. Okay.
And also to move faster on constructing the third fab there as well. But they noted they're adjusting the timelines based on customer demand while also dealing with challenges like labor availability and getting those permits sorted out.
So pushing forward, but facing the practical realities of such a massive project.
Exactly. It's a complex undertaking.
Okay, one final point they addressed was shareholder returns. What's their preferred approach?
They made it pretty clear. They've concluded that providing a sustainable and, importantly, a steadily increasing dividend is their preferred way to return cash to shareholders.
So dividends over share buybacks.
That seems to be the strategy they're prioritizing going forward. A predictable, growing dividend stream.
All right. Well, that covers a lot of ground from TSMC's latest update. Quite a detailed picture.
Indeed. Lots of significant developments and future plans laid out.
Thank you for walking us through all of that, and thanks to everyone listening to this analysis of TSMC's results.
My pleasure.
If you found this breakdown helpful, please do remember to like this and subscribe for more explorations like this one in the future. We'll see you next time.